United States was fine. But here we are in a situation where once again inflation comes in either in line or soft, and the jobs numbers are the ones that continue to deteriorate. So is Fed policy error really underway? Well, we clearly now have a very high odds of a Fed rate cut in September and the beginning of a new Fed cut cycle. But let's take a deeper dive on the impact of what inflation came in at and what you need to know. So, what I want to do is start off here by actually just looking at the inflation numbers themselves. The core CPI was the one thing that everyone was watching. Expectation was coming in at 30 basis points, and it came in exactly in line. Bottom line is that when you take a look at the core inflation numbers over the last 2 years, it literally has remained unchanged. There's this, everyone's been in anticipation of when will the tariffs translate into some form of inflation and the rising of prices. That simply has not materialized at all. And we have inflation that comes in just in line at this stage. If we don't start seeing any impact on these inflation numbers, we were anticipating that there could be an uptick, though it is widely accepted that it would be transitory, and therefore it really has no real inflationary impact on the long term, which is where monetary inflation becomes a concern the way it was in 2021, 2022. Quickly, just looking at the other numbers, the main CPI number came in at 20 basis points. Again, very light. Like, take a look at the way that these numbers over the last 3 years have been coming in and compare that to 2018 and 2019. Point being is that the inflation numbers really have done absolutely nothing out of line that is yet in any way concerning. And yet here we are with the Fed saying we weren't able to cut for the last 6 months because inflation was such a concern. Look at the CPI year over year coming in at 2.7%. Again, look at the fact that in the last 2 years, essentially since the mid 2023, that generally inflation has been in a downwards trend, even though it's relatively flat. Point here is inflation is not a problem, but jobs are, and this clearly is now evident in the case. And we now have a Fed that really does need to start cutting. So let's talk about a couple of quick things. First of all, the U.S. recession odds jumped from about 12% to 15% over the since the jobs numbers coming out. Now that is a realistic number. Why? Because, well, there's only 4 months left in the year, and recessions are measured by quarters, and so the window for 2025 recession is slowly closing. But still, a 15% is a pretty high number for that kind of a context. But what we really want to temporarily focus on is the fact that right now the odds of a September rate cut are sitting around 82%. It was actually as high as 89% earlier, but we are in a situation where it really is now being baked into the cake that the Fed has to start cutting. Now, what's interesting is that this initially is being interpreted by a stock market that is rising, but I want to remind everyone that the most vicious stock market declines have actually occurred during extended Fed cut cycles. And so the fact that the Fed is about to start cutting into a seasonally weak period of the stock market, this kind of August, September, October period, is not something that is a vote of confidence, in my opinion, about the stock market. But what I want to highlight is that when we go to December, you can observe here now the odds of 3 rate cuts by the end of the year jumped to 56%, with only a 1 in 3 chance that they do 2 rate cuts. We are clearly now seeing that the market is saying that the Fed is going to start a sequential series of Fed rate cuts, and pretty much every single meeting at this point is at least to a 56% probability the more favorable outcome that we're going to see that. So let's take a dive into what are the first impacts onto the charts and the markets. Well, it was very well known, whether you looked at the Goldman's anticipation or J.P. Morgan desks anticipations, was that if the number came in line or lighter or softer inflation number, that the first reaction is the stock market higher. And here we are, up 30 points. What I love about this is that we find ourselves in a situation where this is now going for a direct retest of the highs. And to me, one of our big theses is that the major bull run is more or less over. This is the eighth or ninth inning of that bull run, and we're transitioning into what is known as a distribution phase. A distribution phase is not a bear market. A distribution phase is a stock market that has a ceiling. In other words, every time the market rallies, it's distributed. The market rallies, it's distributed, and therefore there's an ample supply of stock up there. And so question now is that with today's strength, are we going to see in the next 24 to 48 hours, as we head over to the PPI inflation numbers in a few days, will we see the rally fade? There's a very good chance that. Why? It is option expiration week. And this is where there's a large amount of gamma. The gamma is building every single day on all of these options that are going to expire. And more often than not, though, that causes dealers to pin the market. What does that mean? It means that in order for them to stay delta neutral, they are selling into rallies and they're buying dips, causing the market this week to stay pinned. And with the fact that the market did not make a big CPI move, odds are very reasonable that somewhere around the 6,400 level, we're going to see some gamma pinning, which is that this morning's rally is got a very reasonable chance of simply fading. Nothing bearish. It's not really even tradable 30 S&P points unless you're a day trader. Point is that you shouldn't be rushing out to do some new aggressive buying on the market because of this move here on the short term. Expect the stock market to start behaving heavy. This is late innings of this a really amazing bull run that we saw, and inevitably mean reversion during a period of seasonally weak markets, which is in that September-October window, is reasonable. And all of it could really start coming together by the September jobs number, and of course by the mid-September Fed FOMC meeting, where that first rate cut will occur. That's where I think the market has the most vulnerability. August has a very reasonable chance of being pretty boring. So what do you need to know? Well, first of all, S&P, don't really buy into this for a long-term new load the boat kind of upside. There's going to be some heavy resistance here. If anything, you buy dips and you have to look for the sectors that are turning up that may actually take some sector rotation flows in the coming weeks. So let's talk about some of the other asset classes, particularly the dollar. Dollar weakened a little bit on that CPI number. Obviously, when the odds of more rate cuts are being baked in, it generally is softening the dollar, so it's fading a little bit. But I want to really focus on this on the individual currency pairs. I want to start with this euro, and what we can observe here is that the euro has essentially still holding above its 50-day moving average, and I would argue is probably the strongest looking chart of the cross currencies. When we're going to look at some of the other ones, you'll see how the US dollar actually looks bullish against some of these. The euro, this still was on that jobs number was just basically a hit down into the fib retracement zones, and since then has recovered back above the 50-day. Whether the euro can break out to make a punch to 120 or 121 is going to decide the fate of the dollar index, because it is such a huge weighting in that currency pair, sorry, in the currency basket. Now, the other one that's also on a knife's edge is the pound sterling. What you can observe is a very classic zigzagging formation down into a fib zone, and it's trying to bullishly break out of this wedge to the upside and close above this 50-day moving average. If we get that and a simultaneous breakout of the euro, that may be enough to allow the US dollar to weaken back down to its lows, or even temporarily break to a lower low. And so these two currency pairs are the ones to watch. Now, where are we seeing some US dollar strength? Well, notice here that the US dollar has been relatively strengthening against the yen for 2 months now. Higher highs, higher lows. It's been over a month. Closing above the 50-day moving average each time, finding support there. Lots of room for the US dollar to actually rally against this yen. Similarly, when we go look at that US dollar against the Canadian dollar, look at the CAD pairing here. What you see is a basing formation on the US dollar down along the lows, almost like a cup and handle formation, where suddenly this little 50% retracement testing the 50-day moving average, if it becomes a support line, there's room for the US dollar to rally against the Canadian dollar. You look at the Australian dollar, almost a complete flip of that chart, which is basically the Aussie dollar failing to rally. If it breaks down below this 50-day moving average after a failed attempt to rally, this could also be the beginning of a turn. So you can really come to the conclusion that it's all in the hands of the euro and the pound as to whether the US dollar has another major leg down. It's all these other currency pairs are already weakening against that US dollar. And so if we see that the euro, let's say, double tops and rolls over, then the U.S. dollar squeeze on the upside is still possible, but clearly not on the very short term. This week, it's still a U.S. dollar that's testing its lows, and I don't really think that that's where the big trade is. I want to move on and talk particularly about gold, because gold faded off of peace talks with Russia over the weekend. The question, of course, did this derail the gold move? To me, the gold miners themselves are actually giving it some interesting clues. Not only did they break the 52-week highs, but when yesterday's selling came in, the buy on dip traders almost immediately rallied it back to the highs. And so we have a generally a market that isn't totally spooked yet. And what I would just simply watch is the December contract here. Notice that the pullback on the December gold contract is more or less pulled through its retracement zones right at the 50-day moving average. Now, while it was a violent drop yesterday in gold, to me, one day doesn't make a new trend. It's literally going to be how gold trades in the next 48 hours. If we see it rally back to 34.50 on the upside, then this could have just been one big buy on dip. Whether the support line holds is going to be critical here. It's certainly not a bad proposition to at least attempt to buy gold here along this 50-day, because the risk can be managed so easily. The asymmetry is actually half decent because the loss can be managed down to a very small stop. And if this thing works, it will potentially have a much bigger upside than the risk you actually have to take for being in the trade. So just quickly, I want to just touch on crude oil. Nothing really happened. The key here is that crude oil has broken these lows. And the big question here is clearly weakening on the short term on the idea that, well, if there, for whatever reason, is a peace deal sorted out that ends the Ukraine confrontation, that many of the sanctions on Russia will be lightened, and the flow of Russian oil may impact oil prices, which is why many are fading this on the downside. My little thought exercise is, what if this is going to be the opposite of what happened if you go back to the start of the war? Everyone, in anticipation of the start of the war, saw crude oil basically rip from $60, basically doubled, went from 60 to 120 plus on the upside, and then wiped the moment the war started. Oil wiped out 50% off of that high. And so I wonder whether or not we're going to have a similar situation where this is weakening on anticipation of the end of the war. And then the bottom of oil actually happens once that actually becomes a reality. Is it going to be the sell the rumor and then buy the news event? Pure speculation initially, but this is not out of character of what we have seen oil do in the past. And so it'll be interesting to see whether over the weekend, whether or not there is any sort of a turn point in crude at that stage. Finally, I want to just touch on what's happening here in the SOFR futures. I want to talk about interest rates and what they're baking in. First of all, I want to highlight that on the December 2025 SOFR futures, which is looking at where interest rates are going to be at the end of the year, what we can see is they popped a little bit this morning. The big move, obviously, was this 25 basis points that they priced into Fed cuts on that weak jobs number. Now we've been consolidating, and what you can observe is the CPI caused this to pop. The big question here is that can this go and price in an even more dovish Fed for the remainder of this year, where we might get even a 50 basis point cut? That would take September's jobs numbers, in my opinion, to be a complete bomb in order for this thing to jump another 25 basis points. But where I'm most interested to see how things play out here is going to be into the December 2026 silver futures, because now we're talking about having to price in like 15, 16 months of interest rates. Not only all of the rate cuts for the remainder of this year, but more importantly, all of the rate cuts next year, including the circumstances that if Powell is subsequently replaced, what would a new dovish Fed governor be putting in policy? And so with the weakening data and inflation coming in, the big question, are we now seeing this flagging formation going to open the window for a further rise in these? Are we going to start right now? We're just a stone throw away from 3% interest rates in the SOFR futures by the end of next year. Could we go down to 275 basis points or 250 or even 200 basis points if it really becomes clear that a deeper Fed cut cycle will be needed? This is the chart to watch, in my opinion. Very asymmetrically skewed, where I think if you carry this contract, you have, in my opinion, a very marginal and manageable downside risk, while the upside potential for a surprise and Fed policy error is extraordinary. One of my favorite places to be in from a trade perspective. Finally, I want to talk about long duration bonds. Now, we have seen that they have finally stabilized on the 30-year bond, and we've traded to the top end of these ranges and are consolidating in this flag. We were looking to see whether today's inflation number was going to spur a potential breakout. At this moment, it wasn't enough of a weak number to really get this going. But maybe by the time we see the PPI and retail sales, it'll be interesting to see whether those long bonds really get things underway. All right, so that's what I wanted to review in here. Let's just have a look if there's something else that we needed to cover here. Uh, 1 second here. No, no, it looks like we are good. So, nonetheless, just to recap everything in here, the inflation numbers clearly are not a problem, and this idea that even transitory inflation, even if we do end up getting 1 month next month where we have a short-term uptick because of it, It's clear at this moment these are not going to be scary rises in inflation. And more importantly, monetary policy is the wrong tool to fight transitory tariff inflation. There is simply not the type of growth in the monetary base and money supply, and also the other types of credit expansion in this tight credit market that would cause real inflation problems. So the problem is clearly the jobs numbers. And if that's continues to be proven the case, then Fed policy error is going to result in the Fed having to ease a lot more than everyone's expected. And that, in my mind, continues to be where the focus of your